Welcome to Breaking News to Trading Moves, and welcome to the debate. Usually when we talk about a medical diagnosis, there is this expectation of precision. Like engineering.
Right.
You break your arm, the x-ray shows that jagged white line, and the doctor just points and says, there it is.
Yeah, it is entirely binary, broken or not broken. It is visible and categorized.
But then you step into the world of behavioral finance and trading psychology, and suddenly that x-ray machine is, well, it is just malfunctioning. We are looking at an analytical landscape that is entirely murky.
Oh, completely.
And if you're listening to this, you probably think you are far too rational to fall for the cognitive traps we are about to discuss. But the data tells a very different story.
It is the absolute definition of diagnostic muddy waters. I mean, it catches everyone from retail traders to institutional managers.
Exactly. We're here to establish a clear answer to a central question. When investors hold on to losing positions and quickly sell winning ones, a phenomenon known as the disposition effect, is this a psychological flaw that requires strict mechanical rules, like trailing stop losses to correct?
Or, is it a logical outcome of distinct investment styles where mechanical rules actually destroy value?
Right. I represent the view that this behavior is a psychological flaw rooted in self-justification, requiring strict mechanical risk reduction tools.
And I represent the view that this behavior is a structural outcome of rational investment strategies, such as value investing. From my perspective, rigid mechanical rules underperform compared to context-aware strategies and protective options.
To begin, we have to look at the behavioral reality of the human mind. The disposition effect is, at its core, a psychological flaw. The data on prospect theory and self-justification is overwhelming.
Overwhelming is a strong word, but go on.
Well, it is. Investors consistently hold on to losing stocks to avoid the psychological pain of admitting a wrong decision. We have all been there, staring at a red screen, convincing ourselves a trade is suddenly a long-term investment, just so we do not have to click sell and realize the loss.
The pain of taking a loss is real, certainly. I am not denying that. But you are attributing a market-wide phenomenon entirely to emotion.
Because the numbers prove the emotion drives the action. When we examine trading records, the propensity to sell jumps exactly at the zero return mark. That is not a coincidence. That is mental accounting in action.
Mental accounting?
Yeah. Investors are desperate to avoid closing a mental account at a loss, so they hold on to failing assets, hoping to break even. Because human psychology is flawed in this manner, I argue mechanical interventions are absolutely vital.
What kind of mechanical interventions are you prioritizing here, though?
Specifically, trailing stop losses. The literature demonstrates that while trailing stop losses do not necessarily increase overall returns, they drastically cut risk. Researchers have proven this using block bootstrapping techniques.
Okay, let us explain what block bootstrapping actually means for the listener, because that is a dense term.
Fair enough. Think of it as taking chunks of historical market data and reshuffling them to simulate thousands of alternate, parallel universes of future return paths. Across thousands of trading days in these simulations, a trailing stop loss reduces the return standard deviation to between 52% and 71% of a standard buy and hold approach. We need these mechanical tools to save us from our own cognitive biases.
I think you are giving human rationality too much credit for the problem, and mechanical rules way too much credit for the solution.
How so?
We have to look at the structural reality of the market, not just individual psychology. When we analyze 3.6 million mutual fund observations, a completely different picture emerges. The data shows that value funds naturally exhibit a 3.8 percentage point disposition effect.
Which simply proves my point. The managers running those funds are human, and they are holding on to losers.
No, it proves they are doing their jobs. Why do value funds exhibit this? Purely because their stated rational strategy is to buy mean reverting losers. Let us break down how a value fund actually operates.
Go ahead.
By definition, they are contractually obligated to buy assets that are trading below their intrinsic value, assets that are down, and hold them until they revert to the mean. They are essentially paid to catch falling knives and wait.
So you are saying the mandate itself mimics a psychological bias mathematically?
Precisely. Growth funds, conversely, exhibit a negative 2.1 percentage point effect because their strategy relies on momentum. Cutting losers and riding winners. This behavior is a feature of factor investing, not a bias.
I see. Furthermore, mathematical modeling of investment returns demonstrates that in random walk environments where an asset's past price movement cannot be used to predict its future movement, stop losses actually underperform a buy and hold approach. The disposition effect, when viewed through the lens of institutional style, is not an irrational flaw. It is the mathematical manifestation of value investing.
I hear your point about institutional style, but let us look at the broader scope of professional management. If we accept that even professionals are trapped by this behavior, what is the actual tool we use to break the glass in case of emergency?
I'm not sure there is an emergency.
There is, though. The research explicitly shows that even professional U.S. mutual fund managers exhibit the disposition effect across the board. These are highly trained, highly compensated individuals with access to vast analytical resources.
They have the resources, but they also have strict parameters.
Yet they still fall prey to holding losers too long and selling winners too early. This proves that the disposition effect is a pervasive human psychological trait, not just an amateur error or a mere byproduct of a specific mandate.
I come at it from a different way.
Well, think of it like a pilot flying in a cloud. Your inner ear lies to you about which way is up, so you must trust the mechanical instruments. A trader must trust a mechanical stop over their own pride. If even the professionals are grounded by their own cognitive dissonance, mechanical rules are the only objective instruments we have left.
Sure, trust your instruments in a cloud, but what if your instruments are calibrated for a massive commercial jet and you are flying a small helicopter?
That is a bit of a stretch.
Is it? That is what mechanical stops do. They apply one rigid rule to completely different market structures.
The instrument panel of capital preservation applies to any vehicle in the air. A loss is a loss.
But you are looking at the psychology and completely ignoring the math of the control groups. Let us examine the evidence by looking at mutual fund managers who run both value and growth funds simultaneously. This is the ultimate test.
Okay, let us look at them.
If the disposition effect were purely a pervasive psychological flaw, that specific manager would exhibit the exact same holding and selling patterns across both funds because, well, they share the exact same brain.
But they do not?
No, they do not. The manager's selling behavior aligns perfectly with the specific fund style, not their own internal psychology. They exhibit the disposition effect in their value fund, and they exhibit the reverse disposition effect in their growth fund. It is entirely structural.
Still, they are humans pressing the buttons.
But the empirical evidence demonstrates that the economic impact of this behavior on actual fund performance is minor. It is a mild behavioral twist rather than a performance-eroding crisis.
Even if we concede that institutional mandates dictate some of this behavior, it does not negate the necessity of mechanical risk management for the broader market. When human judgment is impaired, whether by a mandate or an emotion, we need a fail-safe. Trailing stops remove the emotion from liquidating a losing asset.
Let us talk about the actual mechanics of that fail-safe, because I argue it is structurally flawed.
Let me explain the mechanics of how this functions in practice first. A trailing stop automatically adjusts upward as the security price rises, but it never moves downward.
Right.
So if you buy a stock at $100 and set a 10% trailing stop, your exit is at $90. If the stock climbs to $200, your stop automatically moves up to $180. If the asset reverses, the stop is triggered, and the asset is liquidated without requiring a human being to confront their own failure.
Wait, but does that not just mean you are locking in a realized loss during a normal Tuesday market dip?
It means you are surviving. By mechanically moving the stop price up with the asset and transferring the proceeds to a risk-free asset, like a one-month T-bill, or redirecting capital into the S&P 500, trailing stops provide necessary portfolio insurance.
Insurance that constantly trips itself.
They lock in gains and prevent a standard retracement from spiraling into a catastrophic capital loss. That 52% to 71% reduction in standard deviation I mentioned earlier is not just a statistical artifact. It represents real capital preservation. It is a mathematical firewall against ruin.
That firewall is built on very shaky ground. Stop losses are highly vulnerable to temporary market pullbacks. We call it getting whipsawed.
Whipsaws happen, yes, but
A normal market retracement triggers the stop, forcefully turning a temporary paper dip into a realized capital loss. The asset drops, your stop takes you out, and the next day the asset rebounds, leaving you entirely sidelined during the recovery.
being sidelined with capital intact is better than riding a stock to zero.
But you do not have to choose between those two extremes. I propose protective options, specifically married puts, as a vastly superior alternative. Yes, they cost a premium upfront, but look at the mathematical payoff. Let us break down a married put for the listener.
By all means, explain the cost structure of this alternative.
When you own the underlying stock and purchase a put option, you strictly cap your downside at the strike price, but you maintain unlimited upside potential. If the stock goes to zero, your put option gains value proportionally, covering the loss.
Right, that is basic options theory.
This combination essentially creates the net payoff of a call option. It allows the investor to survive short-term volatility without capping their ability to hold through the turbulence. You are buying actual portfolio insurance, whereas a stop loss is just an illusion of safety that routinely destroys capital during standard market volatility.
Protective options sound great in a textbook, but they require constant rolling, premium payments, and a high level of mathematical sophistication to price correctly.
They require effort? Sure.
Every time you buy a put, you are dragging down the portfolio's performance over the long term. It is a constant bleed of capital just to avoid setting a free mechanical stop.
It is not free if it whipsaws you out of a recovery.
I see why you think that, but let me give you a different perspective on momentum. Let us bring in the data on alternative strategies that do not rely on paying options premiums. When we utilize mathematical ranking rules based on maximum drawdown and successive recovery, we see consistent outperformance over traditional cumulative return strategies.
How exactly do these mathematical rules improve upon the basic stop loss?
Instead of relying on a human to manage an options portfolio, we can assess short-term recovery mathematically. If an asset suffers a severe drawdown, the mechanical rule assesses its recovery trajectory. These mathematically disciplined, trend-following rules remove human judgment entirely.
But
Wait, let me finish this thought. The data shows that monthly momentum and weekly contrarian portfolios constructed using these alternative selection criteria are superior at forecasting asset price directions. They provide consistent success precisely because they enforce a mechanical discipline that human psychology naturally resists. We do not need expensive options. We need rigorous math.
That is a compelling argument, but have you considered how those rigid mathematical rules fail when applied across diverse market structures?
You keep relying on momentum and trend-following algorithms as universal fixes.
Because they work.
let us examine sector-specific behavior. The research on SPX exchange-traded funds utilizing the Hurst exponent and stationarity tests reveals why blanket mechanical rules, whether they are stop losses or rigid momentum rankings, often result in value destruction.
I am familiar with the Hurst exponent, but let us define it clearly to show why it does not negate the need for risk rules.
The Hurst exponent measures the long-term memory of a time series. Essentially, it tells us if a market is trending or if it naturally snaps back to its average. A value exactly at 0.5 means the market is a random walk, completely unpredictable.
Right.
A value above 0.5 indicates a trending market, where momentum rules work beautifully. But a value below 0.5 indicates mean reversion.
And your argument is that mechanical rules ignore this threshold.
Completely. The data shows that entirely different sectors have entirely different structural profiles. If a sector falls into what we call the fading momentum quadrant or the potential reversal quadrant, like the materials or technology sectors during certain cycles, applying a rigid stop loss or momentum rule is a mathematical error.
I disagree that it is an error to preserve capital.
You're punishing assets that are simply behaving according to their sector's normal distribution. A context-aware strategy recognizes whether an asset is naturally mean reverting or naturally trending. A mechanical rule is blind to that context.
Context is valuable, certainly, but it often serves as just another intellectual cloak for self-justification. When a trader says, "Oh, I am not selling this losing position because the Hurst exponent indicates it is in a potential reversal quadrant," they are often just rationalizing their refusal to accept a loss.
Or they are correctly identifying that the asset-specific volatility profile means a bounce is statistically probable.
But that is exactly how the cognitive trap operates. The complexity of the market does not override the simplicity of capital preservation. You can talk about fractional Brownian motion and long-term time series memory all day, but when we review the aggregate data across decades of trading, human psychology inevitably drives poor holding decisions.
I am not denying the emotion exists.
Well, the reluctance to realize losses is a universal human trait verified across retail accounts, professional futures traders, and institutional managers.
I am denying that emotion is the primary driver of the statistical anomaly we call the disposition effect.
Because we cannot trust our own cognitive processes when money is on the line, disciplined mechanical risk reduction remains essential. Trailing stops and mechanical ranking systems protect long-term capital survival. By forcing action when our psychology demands inaction, they cut the noise.
But forcing the wrong action is not a solution. The core of my argument is that market structure and specific investment styles drive behavior far more than retail cognitive errors do. When a value fund holds a loser, it is executing its mandate.
Right, but forcing the wrong action is not a solution.
When a specific sector ETF drops, it may be reverting to its mean, perfectly in line with its historical distribution.
And when a retail trader holds a tech stock down 80%,
that is a mistake. Absolutely. But attempting to overlay a blunt mechanical rule across all these nuanced structural realities results in selling at the exact wrong time for the majority of market participants. Therefore, context-aware strategies and protective options serve capital far better.
it is a lot of extra work.
They allow investors to weather the natural volatility of the market, honor the specific structural mechanics of different asset classes, and manage risk without severing themselves from future upside.
Well, considering these competing perspectives truly reveals the profound complexity of market mechanics. Whether we view the disposition effect through the lens of cognitive dissonance and the need for strict, pilot-like instruments, or through the lens of structural mandates and the need for context-aware options, it is clear that managing risk is not a one-size-fits-all endeavor.
Precisely. The interplay between human psychology and mathematical market structure requires continuous evaluation. You cannot just slap a 10% trailing stop on a mean reverting asset and call it a day. Just as you cannot let human emotion run wild in a trending market without a net.
There is still so much more to explore in the literature regarding how these theories apply across different asset classes, and ultimately, it is up to the listener to determine which approach best aligns with their own trading strategy.
Absolutely. But the next time you look at a losing position in your portfolio, ask yourself, are you looking at a clear, broken gear that requires an immediate mechanical fix? Or are you staring into those diagnostic muddy waters? We will leave you with that thought.